What if I told you that the traditional way of building wealth with index funds in 2026 isn't enough anymore? Gone are the days when simply investing in the S&P 500 was enough to secure your financial future. With the rise of AI-driven tools and a rapidly changing global economy, the way we invest has shifted. So, what's the smarter way to build wealth using index funds now? In this video, we'll break down the top 5 smart and unique ways to use index funds for wealth building in 2026. Stick around for insights that could change the way you think about investing. 1. Adopt a barbell equity approach. The barbell strategy is a smart way to balance risk and reward in 2026. Instead of sticking to the typical total market fund, this approach splits your portfolio into 2 distinct categories: aggressive growth and ultra-defensive stability. On the growth side, you'll allocate a portion to high-conviction tech and AI-focused index funds, such as the Nasdaq 100, NASDX, or tech-heavy S&P 500 growth ETFs, SPYG. These funds capture the upside potential of cutting-edge technologies that are shaping the future. On the defensive side, balance this volatility with low-beta dividend aristocrat index funds or healthcare-specific indexes. By combining high-growth opportunities with stable, defensive assets, the barbell strategy allows you to capture the best of both worlds: high returns with less risk. 2. Move beyond home country bias. In 2026, sticking to domestic investments alone is no longer the smartest move. With a widening valuation gap between U.S. markets and international opportunities, diversifying globally is now more critical than ever. Emerging markets, especially in India and Southeast Asia, are experiencing rapid growth, with expanding middle classes driving demand for goods and services. Funds like the SPDR Emerging Markets ETF, SPEM, give you exposure to these high-growth regions. Meanwhile, developed markets outside of the U.S., such as Japan and Europe, are undergoing significant corporate governance reforms, making them ripe for investment. Using funds like SPDW, which focuses on these international markets, can help you tap into new opportunities, boosting your portfolio's growth potential while reducing your reliance on U.S.-based investments. 3. Utilize smart beta and specialized small-cap indexes. In 2026, investors are moving away from traditional broad market funds that often include zombie companies, those that aren't adding value to your returns. Instead, smart investors are focusing on smart beta strategies and specialized small-cap indexes that filter out underperforming companies. One example is the S&P 600 Small Cap Index, which only includes profitable companies. This filter leads to better long-term performance compared to other indexes like the Russell 2000, which includes less selective criteria. Additionally, thematic indexing is becoming more popular. By investing in industrial and energy-focused index funds that support the infrastructure behind the AI revolution, you can ride the wave of technological innovation and maximize your returns. This shift to smart beta and targeted small-cap investing can help you avoid the pitfalls of poorly performing stocks while focusing on high-potential opportunities. 4. Implement a staggered deployment strategy, advanced DCA. Dollar cost averaging, DCA, is a well-known strategy, but in 2026, investors are taking it up a notch with a staggered deployment approach. Instead of contributing the same amount each month, this strategy allows you to be more flexible and take advantage of market corrections. The idea is simple. For every 3% to 5% drop in the index from its all-time high, you make an additional lump sum contribution to your investment. This approach helps you buy more shares when prices are low, ensuring you take advantage of market dips without being driven by emotion. By following a mechanical discipline of adding more during corrections, you can build your position at more attractive prices while avoiding the emotional trap of trying to time the market. 5. Pair index funds with tax loss harvesting. In 2026, building wealth is not just about how much you earn, but also how much you keep. One of the smartest ways to preserve your wealth is through tax planning, and tax loss harvesting is an effective tool to help you do just that. This strategy involves selling an index fund that's underperformed in your taxable account to realize a loss, which offsets any capital gains you may have earned. Then you immediately buy a similar, but not substantially identical, index fund to maintain your market exposure. This strategy allows you to lower your taxable income, increasing your after-tax returns over time without changing your long-term investment goals. By pairing this strategy with your index fund investments, you can significantly boost your overall returns over the long run, especially if you consistently apply it in taxable accounts. There you have it, The top 5 smart ways to build wealth using index funds in 2026. From the barbell strategy to tax loss harvesting, these smart, targeted approaches can help you maximize your returns and build long-term wealth. If you found this video helpful, don't forget to like, share, and subscribe for more insights into smarter investing strategies. Let me know in the comments which strategy you're most excited to try, and I'll see you in the next video.